Hey there. So, you've got a lump sum of money, maybe from a bonus, an inheritance, or just some savvy saving, and now you're at a crossroads thinking, when should I invest this? It's a common dilemma. You want to make the most of your money, but the fear of timing the market can be paralyzing. Let's break it down together. First off, let's talk about historical data. Research shows that if you invest that lump sum as soon as you can, you're likely to see better returns than if you try to play the waiting game. Markets generally trend upward over the long haul, so the earlier you invest, the more time your money has to grow. It's like planting a tree. The sooner you plant it, the bigger it can get. Now, some folks might prefer dollar cost averaging or DCA, where you spread out your investment over time. This strategy can help ease the emotional roller coaster of short-term market fluctuations. It's like dipping your toes in the water instead of diving straight in. You buy at different price points, which can cushion the blow if the market takes a dip right after you invest. But here's the kicker. While DCA might feel safer, studies show that lump sum investing often leads to higher returns. It's a bit of a trade-off between potential gains and emotional comfort. And let's be real, trying to time the market is notoriously tricky. Even seasoned pros can't predict the highs and lows with any real accuracy. If you miss just a handful of the best days in the market, it can drastically cut your long-term gains. Think about it, missing the best 10 days over a 20-year period could slice your returns in half. Now let's consider the current economic climate. If we're in a bull market, investing that lump sum could lead to quick gains. But there's always the risk of buying at a peak, only to watch your investment drop. Conversely, if we find ourselves in a bear market, it might seem like a bad time to invest, but it could actually be a golden opportunity to scoop up undervalued assets. It's like shopping during a clearance sale. You might be nervous, but those discounted prices can lead to significant gains when the market rebounds. Your personal financial situation also plays a crucial role. Can you handle the possibility of losing some of that lump sum if the market dips? What's your investment horizon? If you're in it for the long haul, let's say 5 years or more, then those market fluctuations might matter less. And of course, do you have an emergency fund set aside? It's essential to have that safety net before diving into investments. Let's not forget the emotional side of investing. If the thought of the market dipping right after you invest sends you into a panic, you might find more peace of mind with DCA. It's all about what you're comfortable with. Your ability to stick with your strategy during downturns is a key factor in your success. Lastly, consider the interest rate environment. In a low interest rate world, keeping your cash in savings accounts or bonds isn't going to yield much. So, investing sooner might be the way to go, allowing your money to potentially grow more in the stock market than it would just sitting idle. In summary, if you have a long-term horizon and can handle the emotional ups and downs, lump sum investing might be your best bet. But if you're more cautious and prefer to ease into the market, DCA could be the way to go. Ultimately, the best time to invest is when you're financially and emotionally ready, with a long-term perspective that doesn't get thrown off by short-term market fluctuations. Remember, the market tends to rise over time, so it's generally better to be in the market than sitting on the sidelines. Now go out there and make that money work for you. If you found this video helpful, hit that like button, subscribe, and ring the notification bell for more tips on making the most of your finances. Thanks for watching.